banks on Friday. In fact, as recently as March 6th, Silicon Valley Bank was the #1 tech startup bank financing much of the venture capital in the industry. Now, 6 days ago, tweeted this out, thanking Forbes for adding them to their best banks list. So, how does a bank with over $200 billion in assets go bust pretty much overnight? It's actually pretty simple. A similar scenario happened in 2008, but instead of real estate, this time it was tech, an even less tangible asset than housing. So, to understand the collapse, you have to first understand that if you deposit your money in a bank, and they don't put it in a vault in the basement, folks, they invest it, they lend it out, sometimes buy their own stock back. Oversimplified, and generally speaking, banks don't physically have all the money in-house they are on the hook for. Banks borrow from the Fed using your deposits as collateral to create revenue for themselves. So for argument's sake, folks, and this is not an exact ratio at all in this heavily regulated industry, using around 10%, round numbers, 10% of a bank's balance sheet is actual cash on hand that you and your deposits make up. Now, the rest of the loan is like a mortgage, just like it is for you. But don't panic, this system works just fine, long as customers don't withdraw 11% of the bank's balance sheet all at once. Knowing that, 3 factors converge to make the perfect storm. First, the Fed raised interest rates, 4%, and the yield curve inverted. This means that the short-term bonds had higher returns than long-term ones. Silicon Valley Bank had over $20 billion in their long-term bond portfolio that yielded less than the cost to service that capital for their customers. In short, SVB's bonds and their investments were costing the bank money rather than making it for them. Secondly, inflation raged on. Okay, the economy slowed. People had less money to invest. In this case, in tech, ripple effect, those tech startups had to draw their revenue to sustain capital and operations, essentially creating a run on the bank. And third, and this was probably the nail in the coffin, as word got out, the bank was a publicly traded company. Their stock tumbled, which means they could not sell enough of their own stock to cover their losses, which is a normal tactic. Additionally, the more they sold, the more the stock tumbled, further compounding the problem. And as stocks values tumbled, it increased the requirement for the bank to keep a higher ratio of cash on hand for the amount they had loaned out. Spiral resulted in the Fed taking control of the bank on Friday. So how does this affect the rest of the banking industry when the markets open on Monday? Well, here to break it down, we have Peter Kalajian, and also with us we have Hillary Fordwich, business consultant, legal analyst. So Hillary, I'll go to you first on this. What happens on Monday when the banks open up and the markets open up and everyone says, we're down a top 20 bank?
Hope, Carl, and pleasure to be back with you again. A couple of things. I mean, in New York City, when the investors went to the bank to try and withdraw their funds, the bank called the police. This is rather like being in a house that's on fire where the firemen are outside saying, don't panic, but really doing nothing. When the SX, Sam Bankman-Fried's cryptocurrency failed, everybody was saying, once John Allen came in, who dealt with Enron, everybody was saying, now the adults are back in the room. So my question to you, back to you, and for everybody to consider is, where are the adults, Carl? The Fed, the Federal Reserve, headed by Jerome Powell, was supposed to be obviously the regulator, but also what about bank management? Banks management, their primary responsibility is for the fiduciary concerns of their investors. So, had they diversified enough? No. They put $20 billion into long-term assets, into bonds, like a lot of banks do, but into long-term treasury bonds. So, when interest rates go up, obviously, what's happened is the yield isn't there. And what you've seen is they have not diversified enough. And also, what was bank management doing just a few weeks ago? Because I'm on LinkedIn, like a lot of us. I saw VB declaring about they were off on a ski trip out in Tahoe, all the women. There is a time when you should be doing your #1 job, and that is your fiduciary responsibility to your investors. So I think they were distracted, and I'd like to know, where are the adults on the Fed side, the regulatory sides? And my last point, Carl, is think about this. All the politicians also in California and in general, where do they get a lot of their donations from? The VCs, and they don't really want to have more oversight because those VCs are pushing back.
Right, but Perry, let's talk about the initiatives here. That this bank, a lot of banks are made up of mom and pop shops. They have a couple $10,000 donation or deposits, 20, 50, 100, whatever, small, below the FDIC limit of 250,000. This bank, like Oprah, stands to lose like $500 million. Meghan and Harry tend to lose a lot of money. They have a smaller pool of very big investors. What does this do for future investments?
Well, I think the thing to look at here is a possibility of some type of contagion, because these large investors, their money is now tied up. And over this weekend, they're looking for the Fed to come in, hopefully get a buyer for the bank, and make this bank whole again so they can go forward. To the extent they can't, and I know some of these entities, they had most or all of their funds in this one bank. So their hands are tied, and they have to meet payrolls and things of that nature. So they're going to have to go someplace else very quickly. I've seen that some of the venture capital and private equity entities that have backed some of these ventures are looking to step up, at least in the short term, to infuse further cash. But this could be the start of something bigger.
Yeah, well, Hillary, that's the worry, is when these markets open up on Monday, is there another run on banks? Because people are like, wait, hold on a second, this happened there, it's going to happen in my bank, I better run down, get my money. You think that's going to happen?
Well, contagion is actually the right word. Everything is, obviously, it is a conscious decision by people who are investors. And yes, if you have the people that are in charge not being in charge, and you see this going on, what are you going to do if you're an investor? Absolutely. I think, unfortunately, whether it's only because of what you started out describing, Carl, because when you see your money in the bank and you see your statement online, it isn't really there. And when investors realize that, yes, it could actually spark a contagion. As somebody in the business world, though, my concern also is all these startups, of course, were backed, lots of them, by SVB. What about the businesses? What about the layoffs? This is going to compound mass layoffs in our economy. That's where you're going to see it as well. So the bank run, yes, just because it's all emotional, and two, because of what's going to happen to the economy, unemployment. And last point, Wells Fargo on Friday didn't make payroll. Now, they said it was a computer glitch. It might have been, Carl, or was it?
Wow. But that's the other thing, too, is you're having all this, forget payroll. The technology development stops when these tech startups can't do this. But Perry, you've been writing you wrote a great piece about ESG, but in the same vein, this bank actually was heavily invested in the DEI, ESG. Like, this is a pretty woke bank. Is this just one more example to what you've been talking about?
I think so. I mean, the area of ESG, it's basically exploded, including in the last week or so. The left likes to use avoid the legislative process, and they did an end around, for instance, with the Department of Labor, where they recently amended the ERISA statute, or retirement statute, and basically told the fund managers that they can now consider ESG aspects in their investment decision. And that flies in the face of the historic fiduciary duty that these parties have. The way the left justifies that is to say that ESG factors actually have an economic benefit. But looking at the 1, 5, and 10-year record of ESG funds against the mainstream indexes, they trail. And there was an article in the Wall Street Journal actually this weekend that said just that. One other thing, people are aware of this because the House and the Senate in the last 2 weeks have both passed bills in opposition to, for instance, the Department of Labor amendment. Unfortunately, President Biden has said he will veto the measure.
Of course he will.
So it may go for a naught, but I think it's at least evidence that people are aware of what's going on.
I mean, I'm not a fund manager, but you know what? I do believe that you should probably invest in things that make you money and not the things that don't. Hillary Fordwich, Perry Kalajian, we appreciate you being here very much.